Established in 1930, Canadian General Investments is North America's second oldest closed-end fund. Greg Eckel at Morgan Meehan & Associates has managed CGI's portfolio since 2009. He aims to generate a better-than-average total return from a diversified portfolio of North American equities via prudent stock selection and timely recognition of capital gains and losses. The fund has a very strong long-term performance record. It has outperformed the Canadian market by an average 2.4 percentage points per year over the last 25 years, and by an average 1.8 percentage points over the last 50 years. The manager believes that it can be considered as a one-stop shop for investment in Canada. He has an unconstrained approach within the remit that a maximum 35% of the portfolio may be held in a single sector. Eckel invests without reference to the sector weightings of the fund's benchmark, meaning the company's performance may differ meaningfully from that of the S&P TSX Composite Index. While most of the fund is invested in Canadian companies, up to 25% may be held in U.S.-listed businesses, which are primarily in niche operations or areas that are underrepresented in the Canadian market. Stock selection is primarily on a bottom-up basis, although Eckel does take the macroeconomic environment into account. The manager seeks reasonably valued companies with favorable fundamentals and strong management teams. The portfolio typically has around 60 holdings, with a bias to large and mid-sized stocks. Some of these are higher yielding, such as the Canadian banks, helping to support the fund's own dividend payments. A notable feature of the fund is its low turnover, which averaged 7.9% over the last 5 years, implying around a 12.5-year holding period. The fund has a long-standing underweight position in the financial sector, which makes up around a third of the Canadian market, as Eckel finds better opportunities in other areas. In terms of overweight exposures, there is an above-index weighting in technology, which has been beneficial to the fund's performance. This has been helped by meaningful holdings in U.S.-listed NVIDIA and Apple. NVIDIA has been in the portfolio since 2016, well before investors started focusing on the company as a potential beneficiary from the growth in artificial intelligence. The fund pays regular quarterly dividends. From 2018 to 2024, the annual dividend was increased by 4 Canadian cents per share each year, and there were no special dividends. In 2025, the annual dividend is on course for a larger 8 cents per share year-on-year increase. Given the company's very high level of unrealized gains, the manager believes that the strategy of rising annual dividends is sustainable. The company has employed a leverage strategy since its first issue of preference shares in '98. In June 2023, the last tranche of preference shares was redeemed, and the amount borrowed under the company's margin facility was increased, rather than issue new preference shares. The current facility is 200 million Canadian dollars. The fund has a persistently wide discount, which may partly be due to the limited free float, as 52.5% of the share base is held by inside owners. The company is unable to repurchase shares to help manage the discount, as this would invalidate its favorable Canadian Investment Corporation tax status. If you would like to find out more about Canadian General Investments, please visit the Edison Group website.